Microsoft is one of the largest companies in the entire world, boasting above a $3 trillion market cap. It has also clearly performed very, very well as a stock, up over the last 5 years, 170%. And then over the last decade or so, up from about 40 to 50 to where it is now at 424. And that doesn't even include dividends on top of it. Now, Microsoft has performed well. I don't think most of you watching this video are shocked, but it's important to look, okay, where is it going to be? Is it still a good investment? In my opinion, Microsoft's leadership has proven that they can produce money and value to shareholders, but how is that going to be in the future? Today, we're going to be covering all sorts of things pertaining to Microsoft stock, from its revenue to its profit to what they do to its revenue streams, and we're going to be looking at that today. When investing in a company, it's important to actually know what they do. I know all of you know what Microsoft is, but they have 3 key revenue streams with lots of stuff leading into that. The first being the business side of things. So that would be like Office, Microsoft 365, LinkedIn, that sort of stuff. And that often is a lot of their software, and software has really high profit margin. So it's a very good business for them. And then another one is their cloud computing, That is also a very fast growing aspect of it. It's also pretty high profit margin, not quite as high, but about 45%. That's still very, very good. And like I said, that's growing fast as well. And then they have the personal computing side of things, which is also pretty large. It has slightly smaller profit margin and hasn't grown quite as fast as the other two in recent years, but it's still a huge aspect. You have things like Activision, you have Xbox and that as well. So Microsoft almost is a diversified company in itself. It's so huge. Amazon's like that as well, where they have their thumb in so many different pies. It's good. It's good because in a downturn, there might be some businesses and some aspects of it that hold up better than others. So if you had all your eggs in one basket, and don't get me wrong, I love it. I've done 3 videos on it recently already. It's the semiconductor industry. Yeah, you can have some diversification, but generally, if semiconductors are doing bad, you're doing bad, right? If you sell fruit and no one's buying fruit, you're going to do bad. Weird example for Microsoft, but you know what I'm saying. So diversification is important. Also a huge economic moat. Economic moat is so important because it's the competitive advantage you have over other companies. They have a huge domination of the office space. I mean, most of you use Office and Word and things like that, like with your companies. They just have a huge dominance in that area. And with other things as well, right? They have Xbox, that's competitive. They have a huge name. Most people use Windows computers. I'm using one. Most of you are watching this video, or at least a good number of you are. So they just have such a huge economic moat. And like the cloud computing as well, they have so much money they can pour into that. Billions and billions and billions and billions of dollars in profit they bring in every year. We're going to dive into more on that in the future. But it's important to understand what Microsoft does. And they are a company that has a lot of different tentacles in a lot of different areas. Taking a look at Microsoft's PE, it's 35, and then its forward PE is 32.5. That is pretty high, not crazy high. The S&P 500 is at 30, and then forward PE is at 23 for that benchmark. But we would expect a company that is, one of the largest in the world, has a high moat, has grown very well. I mean, look at the 5-year performance, look at the 10-year performance. Dramatically outperformed the S&P 500. You shouldn't be surprised that it has a higher PE valuation. And honestly, this is probably what I would expect it to be, considering we can take a look at it. They aren't expecting insane growth next year. If this was probably closer to 20, you would probably actually be a bit higher than this in PE. You would expect, certainly where the market is right now. Obviously, Microsoft's a juggernaut, but also one thing to note, GAAP versus non-GAAP, there's nothing really different here. So there's no weird skewing of PE with the writing off debt or maybe a one-time income, whatever it may be. There's nothing really there for this one. So PE is pretty accurate. You always have to be careful to check with that. And then looking at earnings per share growth. So 2022, 2023, 6.5, that's a little low, but that was not a particularly great year for many companies. There was not a lot of growth. So the fact they got 6.5% is actually not bad. Then 20% earnings per share growth from 2023 to this year. And then next year, they're expecting about 10%, which is the average a company grows. Is right around 10%. But so that's pretty good. A little bit better than average considering the 20% they grew that year. But there's nothing like eye-popping like, oh, that's incredible, right? Revenue's also good, 7%, and then 15%, so you're a little bit lower there, but they're expecting a little bit higher revenue growth into 2025. So this is a company that is, yes, growing fast, very large, we're going to talk about later, large moat. We're also going to look a little bit further back on the income sheet, and when we look at the balance sheet we're going to look back to 2019 for the earnings, just to show kind of the growth there. Taking a look at the balance sheet, there's a couple things I want to note. First being debt. We can see debt was $73 billion in 2020. Now it's only $78 billion. And we can see during 2022, 2023, when borrowing money, rates were crazy high, their debt shrunk. It's one that shows to me this is a safe company. They don't really have to borrow. They don't have to borrow. And then two, it shows a company that's planned well, that they also do not have to borrow. But also, I really wouldn't mind seeing debt increase shortly, because this is a company that uses debt well, I would assume. They're a well-run company, so having them borrow really isn't that bad. And also, this is even more dramatic. You get a little bit of an increase, but compared to how much income they're bringing in, compared to how much revenue they do from 5 years ago, the debt is basically half. And we'll see that in a bit, because they're making double the amount of money. So compared to what they're bringing in, the debt really isn't that high, in my opinion, not for the business they do. And I wouldn't mind seeing this increase once rates drop as an investor, right? One thing that's interesting, total current assets is decreasing, but it's pretty small, and it's really not that concerning to me. You can see total assets increasing, liabilities increasing, but it's nothing dramatic. It's right in line what you would expect. So there's nothing here really surprising or scary or sticking out to me. We can see a little bit further back in what they were doing in revenue and compared to now. So they were at $143 billion in 2020. And they're at $245 billion now. So they haven't quite doubled revenue. However, I'm not really too concerned about that, and here's why. I mean, that's even for a normal company, that would probably be pretty good. But we can see from income, right? Operating income. $53 billion in 2020, $109 billion now. So you've more than doubled your income, which is good. And that shows me, okay, so revenue hasn't doubled, but operating income has, and you can see it in the numbers. They're higher profit margin businesses, so like cloud, Azure cloud stuff, and then like Office and their tools, their workplace tools. Those have the higher profit margins, and those are growing faster than like their personal computing stuff, which is only growing like 3%. And that's a smaller profit margin business. So two things can be true at once. Yeah, it's probably just a little bit lower on that, and you would want more than 3%. But it probably also shows that they're higher profit margin businesses that has room to grow quicker. They're investing in that specifically, and it's paying off, because at the end of the day, businesses is always going to morph. There's always going to be different ways. I don't really care if revenue's growing not crazy fast, but you're investing in business practices and your revenue streams that have higher profit margin, and those are growing faster. That's okay. I don't really care at the end of the day, because that shows you're a smart business. But two, as long as how much profits being in is increasing and increasing at rates like double every 5 years, that's 4xing in a 10-year time frame if you have two separate blocks of double. So this is a company that, from what I'm seeing here, there's nothing concerning here, and actually this is quite optimistic. This is raising my spirits about this company, sort of thing, right? I mean, obviously I knew this beforehand, but this looks very good. This looks very good to me. This is a pretty good visual representation of Microsoft's last quarter. Now, you can see 3 revenue streams here inside these, at least most of them. There's lots of different smaller components that go into it. So personal computing, you got Xbox, you got Microsoft. You even have companies like Activision, right? Activision was bought out recently. That is a multiple tens of billion-dollar companies, but it's not even really getting a thing here because, of course, Microsoft is so huge. I mean, $64 billion in revenue in one quarter. That is ginormous. So obviously this isn't everything, but we can see the two key things. Not that this isn't important, but these are the higher profit margin businesses. Cloud computing stuff, 45% profit margin. That's very good. So this is some like business stuff. We got LinkedIn, Microsoft 365, so Office would probably be included in this as well. They have subscription services often have very high profit margins. You see, in Apple, that's why you see such a push for stuff in that as well, like Apple Music, subscription services. So high profit margins, and that's what's primarily been growing. When we look at the income sheet, we can see that revenue hasn't quite doubled over the last 5 years, but profits more than doubled. And that's because these higher profit margin businesses have been increasing faster than personal computing has been. So we can see after all this, at the end of the day, they're making $22 billion of profit this quarter. Isn't that insane? $22 billion in profit. That is ginormous. You can see, cost of revenue. There's that there. R&D is a decent chunk, but it's really not that much. We can see some increases in this, but this is just, it just shows how much of a juggernaut Microsoft is. And you can probably find more advanced graphics. I chose a simplified one so you can see. If you really want to look in all their earnings stuff as well, you can see just how much they bring in from all these different things. It's same thing with Amazon too. These huge, Mag 7, most of them have so many different income streams, at least like Amazon, Apple, Microsoft, that they're almost diversified companies in and of themselves. Now, of course, not completely, but no, it's very, very impressive what they do. But like I said, highlighting mostly the cloud segment that's growing quickly, nearly 20% mark or year-over-year mark, and it's already makes up, 28. It's already their largest revenue stream as well. So high profit margin, high growth. It's just, this looks phenomenal to me. Looking at historical PE is important to kind of get a full picture of, okay, is this company cheap right now? Is it expensive, at least compared to its history? Because a lot of different companies trade a lot of different PE ratios. Over the last 5 years, this company is right about where it has been. We saw in the middle of 2020, it was at 33, 34-ish. You were kind of around there. You were lower in 2022, but everything was lower in 2022. And Microsoft actually not as much as normal, because there was just not a lot of growth happening during that year. And then we're right around 35 again. So in terms of the historical of it, right, since like 2013, the PE ratio is 10. So we're a bit more expensive. But if we look in the last 6 to 7 years, it's not too expensive. Obviously, at some quarters that were down there. That's why the PE spikes. But you see a constant trend upward. And a constant trend upward shouldn't be surprising, because this company has proven more consistently, over a longer period of time, that it can produce earnings and that it's growing exceptionally well. So it's not surprising that you see the PE ratio grow higher and higher and higher as this company has more and more and more wins over a longer period of time. So this is probably where you would expect it to be. Now, only you can answer for yourself if you think it's a good investment. Maybe it's still too expensive for you. But in terms of where it's at, this really isn't anything like, oh, crazy expensive. I don't see it, at least. It is important to talk about risks and advantages that specific companies have. So we're going to do that with Microsoft. Now, of course, I can't cover every single risk, every single advantage. If you have any specific risks you want me to address, you think that are important, that I didn't cover in this video, feel free to ask down in the comment section. I would love to address it. Some key ones with Microsoft, well, a really baseline one is just a higher PE stock, right? 35 PE. That's not, in my opinion, something that should deter you from investing entirely. However, it's just reality. Higher PE stocks are going to get hit harder when the market falls. Now, of course, there's going to be some exceptions, but just make that general assumption and it'll help you diversify. But that's not going to stop me from investing in Microsoft, because generally a lot of the companies that grow more have higher PEs because they have track record of growing more. People want to pay a higher premium for that. But during a recession, when everyone's panicking, these companies get hit harder. Another one is they have huge dominance in some areas, like with office space. It's a very unlikely percent chance, right? But if there was a company that started like taking some market share, even like a 5 to 10% cut out of Microsoft is a lot, because if you're only growing, 10% a year, you're literally losing a year of growth in that specific sector. Now, I think that's unlikely, but there's always things, and then there's risks to specific things like specific brands, of course, but that's pretty small portion of the market share. The main one I see too is, well, like in cloud stuff, right? Cloud and AI. If they were to start losing there, let's just say Meta, right, investing a lot of money, or Apple really hits it out of the park with one of the AI things. They find a way to use it no one else is, and they almost have a proprietary advantage in that. That could really hurt Microsoft, not even necessarily because they're doing terrible, although that could happen too, but also people would prefer to invest in the other company. They have higher PEs, something like that. But you can also diversify that by just owning the S&P 500, right? Or owning a lot of the huge players in AI to diversify out of that. But I think that those are pretty unlikely risks. Honestly, Microsoft's one of the safer companies. Of course, you always have a small chance that anything bad could be happening with the company. It's very unlikely. Certainly with the larger companies, it's harder to get away with that. I'm talking about like the messing with numbers and books and things, and you can't really hedge against that except for not owning all your money in one company, things like that. So there's very, very few like huge glaring risks. Microsoft has a lot of advantages too. We've talked about it earlier in the video. Their moat is huge, so I'm not going to harp on that too much, but it really is large. And when you have, we talked about earlier, you're bringing in 254 billion dollars in revenue, $100 billion in profit every year, and you really only have $78 billion in debt. There's just so many things you have going great for you. Microsoft, even if it underperforms, I would be shocked if over the long term this company stagnates. It can always happen. Companies get bad management and things like that. There's very few risks I see for Microsoft as a company outside of anything you would expect a normal company to have. I'm not the biggest projection guy when it comes to stock price, certainly not in the short term. I think stocks are sometimes irrational, and there's too many variables to say, oh yeah, in a year it's going to be here. But for these videos, I like to do a long-term outlook where I think the company is and where it's going to grow. I think Microsoft in the long term, excluding recession and things like that, like crazy recession, I think it'll outperform the market. I do. It has a track record of doing so. They're positioned well, clearly one of the larger companies in the entire world. I don't know if they're going to be the best. It's so hard to look in the long term, but the market, you would project it to in an average time frame of 7 years to maybe go up 100% or so. I would expect this company to maybe go up 150 to 200% in that time frame. Over the last 5 years, they've more than doubled profit. Over the last 10 years, I think they've more than 4x'd pretty easily. So that's not going out on a limb. And as long as this company does, 30% less than what they've been doing over the last decade, you're still going to outperform the market, outperform it pretty handily. The issue, quote unquote issue, I think this PE ratio, I don't think it gets much higher than this for the long term. And if it does, it means the company's doing very, very well. One thing we see, and we saw it when we're looking at historical PE, around 2012, PE was 13. It was a decent company, but it wasn't incredible. And PE ratios were much lower back then. You were still just recovering from 2007. You're just hitting all-time highs again right around 2012. So you probably won't get up into the 40s in a few hours because the stock's doing very, very well. But you could actually probably expect this to trade closer to 30 in the long term, assuming it grows, where we expect it to, which is right around 150% every 7 years, maybe 150% every 5 years, something like that. So that's how I expect Microsoft to do. I own this stock personally. I don't think that's crazy to say. It's one of the largest companies in the entire world. Probably most of you watching it are. It's not a bad opportunity to buy. It's not screaming buy, but I would rather buy a great company at it's probably reasonably valued than a terrible company at a quote unquote great price, because terrible companies have a track record of not growing. So I have no issues buying Microsoft around this price. If you're holding for the long term, I don't think it's going to scream up in the next year or two, but hey, if they just keep hitting it out of the park with cloud stuff, if they do well with AI, this is a company that's probably going to grow pretty fast as well. So that's all I really got with this stock. I hope you guys enjoyed watching this video. If you made it this far, you definitely watched quite a bit. So I appreciate you even just for making it this far. But if you're new and want to see similar content, I do daily stock content on this channel, compilation videos, and then deeper dives like this one. So I appreciate all of you for watching, and I'll catch you next time.